Hello and welcome. You're watching the Mutual Fund Show on Business Today TV. I'm Sakshi Batra and joining in on the show with me is Shailendra Bhatnagar, editor for Markets on Business Today TV. Good morning, Shail, and welcome to this show. Well, we've already discussed a whole host of segments in this show already. The flexi cap funds, the large cap funds, the mid cap funds, and now the more exciting ones, the small cap funds is what we're going to be discussing today. So let's begin by getting the basics out of the way for all our viewers for the benefit of them. What exactly are small cap funds and what purpose do they solve in an overall mutual fund portfolio?
So, Sakshi, good morning and hello everyone who's watching us. It's very basic. The smaller the company, the more volatile and more unpredictable the market. But the flip side of that is the returns as a percentage over the longer term, Sakshi, are much, much higher. So, small cap funds, are typically if you have a huge menu in front of you and you are at a buffet. Small cap funds are like, aam ka achar. You really like it, but you can't have aam ka achar for your own meal. It's a
Yeah.
very tasty ingredient to improve the quality of the overall meal, and therefore small cap funds are used very judiciously in the overall portfolio to
Yeah.
add a certain tadka. And that
Oh,
tadka can be
right.
10 to 15% of your overall portfolio.
Okay.
And why do small caps fund matter? Because if you see over the longer term, Sakshi, these funds have outperformed the Sensex, the Nifty, and the mid cap index by a very handsome margin. I'll give you a very simple example. If you see the Y to date return on the index, Nifty is up 7%,
Yeah.
Bank Nifty is up 5%, the small cap index is up 16.8%. Can you beat this? So it's
Right.
2x up the Nifty. And that's how you see these returns over a longer period of time, that they may be volatile, but in the longer period of time, say more than 7 years, they deliver super normal return, and therefore they are used as a catalyst in your overall portfolio
Hmm.
to add a kicker. So that's why small cap funds are necessary.
Absolutely. And you've rightly put it. The phrases that you've used, a tarka, you want to add an extra flavor to it, a kicker, that's what you need the small cap funds for. But like
Yeah.
you were pointing out, are these the riskiest funds category out there? And if yes, then what kind of risks are associated with these funds?
So, Sakshi, typically, while it might sound a cliche, but all blue chips today started as small caps. And
Okay.
it over a period of 20, 25, 30 years that they've morphed into large cap companies. Small cap becomes mid cap, and a mid cap therefore goes on to become a blue chip. So all journeys start with a small step ahead,
Hmm.
as wisdom is there in life, and therefore the reason that these companies are small, therefore they are unpredictable, and their business undergoes a series of very volatile moves, both up and down. So, if you buy a basket of these small cap companies over a period of time via a very good small cap mutual fund, you stand to benefit phenomenally. I'll give you an example. If you see a 10-year period, the Nifty and the Sensex have given a 13% CAGR return every year,
Yeah. Yeah.
which basically means that if you divide 72 by 13, money has doubled in 5.5 years. So
Hmm.
if you invested 1 lakh rupees in a Nifty ETF, 5 years later it was 2 lakhs, and 10 years later it was 4 lakhs.
Yeah.
Correct. Now come to the small cap fund. The small cap index I'm talking about has compounded at 19.4%
Hmm.
in the last 10 years, which
Hmm.
basically means that your money has doubled in 3.7 years.
Correct.
Now, suppose 1 lakh was invested in a small cap index.
Yeah.
It became 2 lakhs in, say, 4 years. Then it became 4 lakhs in uh, 7 years. and roughly, you'll have an amount of something like 7.5, 8 lakhs after the end of the 10-year comparative period. So it
Okay.
makes fantastic sense to have a small part of your portfolio in this kind of a situation. And typically, small caps are anywhere between 200 to 15,000 crore rupees in
Yeah.
terms of market capitalization. And India's small cap sector is very vibrant. You have a 400 crore, you have a 400 company index, a 250
Hmm.
company index, a
Hmm.
100 company index. So pick
Okay.
your choice and invest accordingly, Sakshi.
Okay, so you said completely correctly over here that in the year-to-date period we've already seen the small caps outperform, and we've seen that happen even in the mutual fund space. In the month of June, it was the small cap category that saw the highest amount of fund flows, over 5,500 crore rupees of fund
Absolutely.
flows.
Yeah.
So I wanted to understand from you, which a lot of viewers would have in mind as well, is it the right time then to add a small cap fund to their mutual fund portfolio now?
So Sakshi, the right time was yesterday, and today is also the right time. So it's very simple. See, the higher you invest in the market, the relative returns become lesser. Correct? So, but that doesn't mean that you don't participate in this kind of a rally, because ups and downs are a part of the market. So you have to play the game intelligently. By all means, choose a small cap fund. We have shared 5, 7 names with you.
Yeah.
And the, the best part, the best way to do it is that don't invest in a lump sum at a time when both the small cap, mid cap, and the Nifty index are at record highs. So start by all means.
Okay.
Just keep one small cap fund as 10 to 15% of your overall mutual fund portfolio. For
Okay.
instance, if it is your fund portfolio is of 5 lakhs, then somewhere like 75,000 rupees should be in a small cap fund, and that too via SIPs. So think in these terms that you divide 75,000 by 6 or 12, and you have these wonderful SIP instruments which you can put in that piecemeal number, say 10,000 rupees per month for a 6 year period, or 5,000, 7,000 rupees per month over a 12-month period, and that way whatever ups and downs that you get into the market will be harmonized via the mathematical average of systematic investment planning. And
Yeah.
choose the direct route, choose the growth option. The data
Okay.
that you see, Sakshi, in front of you in terms of returns and
Yeah.
net asset values are for direct option and
Okay.
growth route.
Okay. Yes, in fact, I was going to come to the returns because that is what most of the viewers are wanting to understand. What kind of funds and what kind of returns have we seen? Since we are just halfway off the mark for this calendar year, if you could give us those returns, last 1 year comparison as well for the top performing funds.
Okay, so Sakshi, we've chosen five very good, fundamentally strong funds which have a long history of giving returns over different industry cycles. So our investors and our viewers can choose any one of these funds. Even two is okay. So
Hmm.
you can look at the year-to-date return. It ranges for the last 6 months between 11 and 17%. The 1 year return is anywhere between say 22 to 39%. Now see the wide return range. The least performing fund over a 1 year period in the quality ones is 22%, and the best performing fund is nearly 90% more, which is 39%. So stock choices and how the fund manager navigates the life cycle of a company are critical in terms of how returns are calculated. Look at quant small cap fund. The
Yeah.
3 year return, Sakshi, is 56% CAGR,
Yeah.
which basically means, I mean, I'm astounded. Divide 72 by 56. Your money is doubling in 14 months.
Wow.
So in a 3 year period, 1 lakh rupees is, let's say, uh, 2 and 4. 1 lakh rupees is 4 lakh rupees. And look at again the range of return in a 3 year zone, 27 to 56. It's nearly double. So that's
Right.
what I'm saying. It's a very volatile sector,
Hmm.
but the volatility keeps on decreasing, Sakshi, when you hold the fund via the SIP route over a longer period of time. Look at the
Yeah.
10-year return here. Minimum is 16%, and the maximum is 30%. So
Hmm.
again, look at the volatility.
Yeah.
So if you divide 72 by 30, your money is doubling by say 2.4 in 2 years and 4 months. So that's the beauty that I'm trying to tell you, that if you hold such funds for the longer period of time, and
Yeah.
there are a certain high percentage of your portfolio, say 15-20%, then
Yeah.
that 20% is compounding very fast, actually.
Yeah, yeah, absolutely. These are some spectacular numbers and fantastic data for everyone to notice who've been looking at what kind of returns are being given. So you can actually take into account the 3-year, 5-year, and the 10-year CAGR kind of returns that you've seen on some of these top performers, and the returns even in a shorter period, like the 6 months data which we have shared with you, and over the last 1 year period as well. Shell has also wonderfully explained to you what does this percentage really mean for you in terms of the real returns that you've got in your invested amount. Say, for example, you've taken that 1 lakh rupee amount that you've invested in. Now, Shell, also wanted to understand from you, looking at this percentage, a lot of people would still want to say that 3-year, if this is 56%, 10-year it's 16.5% quant, so why don't I just pull out my money in 3 years? Why is Shell telling me that I have to hold it for 7 to 10 years? What would you tell them?
No, Sakshi, it does not work that way. See,
Hmm.
of course, sometimes you get lucky, like in the case of small cap
Yeah.
quant. If you go drill down their portfolio, they've been phenomenally lucky over the
Hmm.
last 3 odd years. But the overall 10-year horizon, 15-year horizon of quant is a CAGR of 15%. So, like I said, these ups and downs are very, very distinctive in the case of a small cap fund. And if you feel, if you've been super lucky that you invested 3 years ago in quant and your money has grown 4 times, then by all means, book it out.
Okay.
Money in the bank is actually true profit rather than paper profit that people like me have. So it's sensible to always take out some money when the return has been extraordinary. But the limited point I'm trying to make, Sakshi, is that you might be equally disappointed in a 3-year period. I mean, we are sitting in a bull run,
Yeah.
right?
Yeah.
But the disappointments in a fund house or in a fund investment are actually very, very good points for sensible people to add those funds via the SIP. So,
Right.
suppose you add 1,000, 10,000 rupee SIP and the NAV is at 20 rupees, right?
Yeah.
So, you get 2,000 units. Correct? You get 5,000 units, 500 units, right? Now, if the NAV dips to 13 rupees, you get more units for 10,000 rupees. But ultimately, the small cap fund has to outperform the market, it has to outperform the Nifty. So,
Yes.
those 13 rupee purchase is the most critical purchase. A lot of people make this mistake of stopping an SIP when the markets fall. In fact, the SIP works best when the market is sideways to weak. It is
Okay.
for quality people to buy quality stocks at a time when they are in pain. You remember we
Hmm.
used to talk about Infosys about
Absolutely.
10, 15 days ago. I
Yes.
had said that it will rise
Yes.
no matter what the earnings are. So it is now fairly close to say 1400 rupees. And we were very consciously advocating a good
Sure.
purchase somewhere like 1100 rupees. So this
Sure.
is exactly what happens in the case of funds. You have to buy the dip.
Yeah. Okay. Understood, and fair point right there. So I hope that gives a lot of clarity to all the viewers out there as to what should be the ideal holding period for you. What are the things to consider if you may be tempted enough to actually just book it out in a small period of time. The volatile scenario and all the risks that small cap funds also carry. So keep all of these things in mind before you go ahead and invest. So, Shell, if you could also break it down for all our viewers, the key to choose the right mutual fund in terms of small cap funds from among these, what would that be?
Actually, that's like sticking my neck out. just do eeny, meeny, miny, mo, and close your eyes and put a finger on the any one of these top five funds that I have, uh, culled data on,
Okay.
and any one of them is good. See, we have
Okay.
no favorites. We give you the best collection of funds available within a certain category, and you
Right.
can choose whatever you like. Some people invest in a stock and in a fund in the same alphabet as their name, right? So for Sakshi, it could be SBI small cap. For
Okay.
Shell, it could also be SBI.
Hmm.
But for our friend Gopal, or for Rishi, it could be something else. So my point is that look at the best of the best available,
Yeah.
and within that choose any one. I
Okay.
can tell you for certainty, Sakshi, that we don't know what is going to happen in the future. Anybody
Sure.
who says, apart from the compounding, which is the ultimate truth, we don't know what is going to happen over the next 3 years in the market.
Hmm.
But if you mathematically play the market and if you sensibly invest via SIP, no market volatility will defeat you. So
Right.
that's the way forward, Sakshi.
Absolutely. So, three or four key points that all our viewers should remember here. Small cap funds could give you that catalyst effect in your mutual fund portfolio, and that is why they are essential. Look for the funds which we have shared with you, the compounded annual growth rate. Look for a scenario of 7 to 10 years holding period. Start with a SIP of 5,000 to 10,000. Have your investments in place. Choose one or two small cap funds, an allocation of about 10 to 15%, just like how Shell mentioned, from your overall portfolio. So Shell, like I always ask you, we've already discussed now four categories to create a complete portfolio so far from the fund categories that we've discussed. Could you share the allocation level so that this gives a lot of clarity to all our viewers?
Okay, so now Sakshi's question is wonderful. I'm going to just gist the last four shows we've done. The first one was flexi cap funds.
Yeah.
Just keep one fund at 15% weightage to your overall portfolio. Then were the blue chip equity diversified funds. They should be the largest component, anywhere between 30 to 40%. Again, one fund. Mid cap 10 to 15%, again one fund, and small cap 15 to 10% or 20%, again one fund. We have left a small window, Sakshi,
Yes.
that's for international funds, which we'll do next time.
Okay.
The only clarity I want to again say, a lot of people ask me, why can't we buy five small cap funds and
Yeah.
enjoy the most fantastic rally that you can compound at 22% 10-year period. Then I
Yeah.
tell them, see, don't trouble the market. Don't try to be smarter than the market. There is a logic. The market can remain illogical for a longer period of time than you can stay solvent. So it's always good to have just 10-15% as sector allocation for small cap funds.
Yeah.
Choose the direct route, choose the growth option, and choose any one of these funds that we've highlighted for you, and
Okay.
choose maximum two, Sakshi, not more than two. It's
Okay.
indigestion. I can't, have a great meal by having aam ka achar with nimbu ka achar and lisode ka achar. It will
Yeah.
create havoc.
Yeah, absolutely. That's very well put. And lastly, taxation aspect, like we always tell all our viewers, what kind of taxation will all of these mutual fund investments incur, one will need to incur on?
So, Sakshi, in the lovely days when you were in school, everything was tax free when it came to equity investing. But,
Yeah,
death and taxes, they are certain. But
yeah,
in the case of equity funds, still the
yeah,
uh, the taxation rates are far better than what they are in case of direct investing. So, if you hold the fund for more than 1 year and then you sell, the first 1 lakh rupee profit is tax free.
okay.
Beyond that, the tax is at 10% if you hold it for more than 1 year. Now, if you're a short-term player, like we've seen, the beginning of the month, the beginning of the year, and the fund has appreciated 15%, and maybe by March 2024, when the financial year ends, or by December 2022, we might see the Sensex and the Nifty and the Bank Nifty go much higher. And these funds give you a 30% return. And if you're very anxious to bag it, then the short term tax rate is 15% on whatever profit you make. There is
Okay.
no leeway. So that's it. But I suggest that you hold the fund for a longer term. If you think that you want to have a very, uh, a portfolio that you churn a lot, then for your smaller sibling or for your child, you buy a small cap fund in his or her portfolio and keep it for a period of, say, 10, 15 years. Sakshi, I am seriously telling you, when we meet in office, I will show you the kind of returns that people have made. I mean, 15 lakh rupees is 50 lakh rupees
Wow.
over a period of 7, 8 years. And it's consistent. Every fund has given that kind of return. I mean, it might not be 50, it might be 48, 47, 43, 52, 55. But the
Yeah.
fact is the trajectory and the percentage return is far, far higher in a small cap.
That's amazing, amazing, and fantastic data as always. Many thanks, Shell, for sharing all these wonderful insights with all our viewers. And we will continue to get you more insights from the world of mutual funds and how you can continue to make more money via the mutual fund route. What is the right way to approach mutual funds and the right kind of funds that you should have, the allocation, everything we will ask Shell to help all our viewers understand. With this show, we just hope that everybody who is an aspiring investor gets onto the journey. Many thanks, Shell. Always a pleasure speaking. Let's continue to discuss more on the markets going forward as well. So do stay tuned on the Business Today TV channel. Don't forget to subscribe to this channel and also continue to engage with us on our other social media platforms as well.